Hey guys, welcome to Make Money Count. It feels good to be back in this chair.
What's different today?
I don't know.
No earphones.
Oh, no earphones, right? Of
Does
course.
it feel different?
It feels a little bit different. It feels like I like hearing myself talk, right? So, I mean, I can hear myself now, but also it's different with the headphones.
You prefer the headphones?
It's interesting. You don't always hear yourself talking in real time in headphones. So,
I think I kind of feel a little more free without the headphones.
yeah, I can see that.
Matt's still wearing his. Hey, Matt, comment?
He just wants to make sure the levels are good.
Exactly. Somebody's got to.
Yeah. The last couple episodes have been sans me. I've been sad. I've been watching the clips though. Very good. Some amazing people were on the podcast. But now I'm back in my rightful throne.
It's great to have you here.
Thank you. Today we're going to talk about inflation. It's been up. What that means for you, what that means for your mortgage, what that means for 5-year fixed rates. So why don't you take us away?
Where?
Where?
Yeah.
Well, let's start with the idea that inflation is up.
Yeah. So
Inflation and inflation are both up.
I don't know what inflation's doing. Okay. So we had an inflation reading yesterday.
Yup.
And it indicated that month over month we were up 0. I feel like it's so boring when I go through like just specific numbers on things.
People need to know that.
Well, do they really care about like what the reading was and what it was supposed to be? So it was 0.7. It was expected to be 0.4.
Right.
Okay. All we really want to drive home here is that the number inflation came in hotter.
Right.
And the key to that is, why did it come in hotter?
Right.
And what are the implications of that on your mortgage, on the economy? So why did it come in hotter?
I'm going to take property values for 100, Bob.
You know what? I'll tell you something. You are definitely kind of on the right track.
Okay.
Because inflation was driven largely by increases in shelter costs.
Right.
Which is
rental and...
Yeah, which is rental rates and interest costs to service debt on mortgages.
Right.
And so it's funny, right? We're in a kind of weird part of the cycle right now where inflation is causing inflation, because inflation caused the Bank of Canada to increase interest rates. Increasing interest rates caused the cost of servicing debt on a home to increase, which increased rental rates because people either decided not to buy and opt to rent, or the carrying costs of homes also increased simultaneously because interest rates increased. So, rental prices had to rise because the cost of the raw material to rent to somebody increases.
Mm-hmm.
Generally speaking, the increase in interest rates has caused an increase in the cost to shelter.
Right.
And as a result, the inflation reading is up. So
inflation inception is basically what you're telling me.
Yeah. The movie Inception.
Yeah. Good movie.
Great movie. I still don't understand it, but
really,
I mean, whatever. I understand it. I just, there's a lot to it.
Matt could probably do a whole podcast on the meaning of it.
For sure.
Yeah.
Yeah. Anyways, so the problem we're having right now is that inflation reading came in way hotter than expected. And that reading immediately spiked the bond yields. Matt, I sent you the bond yield chart.
Yes.
Do you want to put that up?
Yep.
So bond yields are up now. So you can see here, like in kind of March, we were below 280 and now we're 50 basis points higher. And our highest ever was 3.7. So we're 40 basis points off of that like high print, which was kind of October of 2022. Listen, this is going to cause 5-year fixed rates to increase.
Yeah.
Right. And what this is it's a reading, and that inflation number said two things to us. Number one, it said, we may be increasing, the Bank of Canada may increase interest rates again. They may increase the overnight rate. In fact, fun anecdote, the probability of an increase at the next meeting, which is June 7th, was at like below 10%. And then after that inflationary reading came up, it spiked up to over 20%, 22%, I think.
What's your probability rating?
0. They're not going to increase.
Yeah, that's what I think too.
Yeah, they will not
But
increase.
I just think things that you think.
But so it's
I'm just kidding.
well, I'll tell you what it does mean though is it for sure means interest rates are going to be higher for longer.
Right. Yeah. Of
And
course.
what's driving that really is the resiliency of the Canadian housing market.
Right.
So housing prices are climbing again.
Mm-hmm.
We've had, what is it, Matt? Like 4 months where it's like month over month increase in housing prices.
I looked at it yesterday. Actually, it was the last 3 months in a row, definitely.
You know, I bet you it's 4. I bet you you're just trying to correct me for the sake of correcting me. But for sure, it's 4 months. Just kidding. So it's 3 or 4 months of month over month increasing in housing prices, increasing number of transactions.
Mm-hmm.
And there's another chart I want Matt to throw up that I sent him, which shows you the cost of carrying the debt on a home and how that has increased with variable rate mortgage pricing changes. So look at this. This was mortgage interest costs increasing from the previous year.
Right.
And like, look at that. Isn't that like, it's just such a beautiful chart. But I mean, it's not beautiful for the end result to the consumer that we're up 30% to service debt. Now, this is going to abate as interest rates stabilize and people fix in. Like you can see it already, right? The variable rate is no longer the place to be.
No, definitely
right?
not.
Because you're at a 6.7% prime rate.
Mm-hmm.
Max you're getting off of that is what on a variable rate?
50, 60 basis.
So like even if you had half a percentage point off in the past or a full percentage point off, you're at 5.7.
Yeah.
And what are we getting a 5-year fixed rate right now? Insured? What's insured?
Insured is like 429 or something like that.
And insured? Uninsured, sorry.
Like 484, 489.
Yeah. So like if you can take a 3-year fixed, take a 3-year fixed right now.
Yeah.
2-year fixed. I don't know what those are. Those are probably higher.
Can't tell you off the top of my head.
Anyways,
5.5.
It's interesting to see this expectation that interest rates are going to be higher for longer is now starting to creep into the market, and the market's starting to absorb it. So you're going to see now 5-year fixed rates start to climb higher as a result, and then you'll see them come back down again. Like hopefully this is like the next reading kind of comes back more in line, but it might not.
Right. So your probability for interest rate increase 0%. What is your probability for inflation numbers keep on that they keep rising?
You mean keep beating expectations?
Right. Not rising, yes. Not going down as quickly as we'd hope.
Yeah, I think that as long as you keep seeing this resiliency in the housing market, and more importantly, and we've been talking about this so much, I feel like it's getting picked up more and more in the news now, but we've been talking about how kind of like, 20% of Canadian mortgages are servicing just interest almost. I mean, to some degree, like at least their amortizations are getting pushed out.
Yeah.
So some of them aren't even servicing the interest. So the more accommodating the banks are in those situations, the more resilient the housing market will be, the less of an impact interest rate hikes will have on reining in spending. Although, I mean, we're seeing that already. Like we're in a recession.
Right.
But that the kind of full impact of all of this monetary policy isn't being felt by the market because it's being muted by the way the banks are controlling amortizations on mortgages.
Right. Being accommodative.
Yeah, accommodating their borrowers, right? And in order to create stability in the marketplace, it's important. Like, you're seeing amortizations getting pushed out, but the alternative to that is
evisceration.
Yeah, I mean, you're going to kill your borrowers, and they're going to have to rely on higher interest rate products to service themselves in the interim. And then you're going to see a lot of supply hit the market. And so far, we haven't seen that because the banks have been accommodative to the borrowers.
Yeah.
So, Marcus, let me ask you, we talked about this a bit on the last show. We talked about the supply being part of the reason why, like, there's even a bidding demand, or like there's the reason why prices are going up is because there's a lack of supply. What do you see, like, in the next, like, happening before the end of the year? Do you see banks for, like, keeping to stretch out these amortizations? Do you see supply hitting the market? Do you see interest rates forcing people to sell? Where do you currently stand on everything?
The longer interest rates stay higher, the higher the probability that more supply comes into the marketplace.
And that will be the only deciding factor on whether pricing goes down?
There's nothing else, right? The interest rates aren't going to go any higher. You might spook the market a little bit if you come in and say, we're going to raise 25 basis points, but I don't think that's likely. So yeah, like, really the variable that's going to most affect housing prices is how you can impact supply. And the way supply will be impacted will just be, if the banks somehow change how they're dealing with these people that have kind of blown out their amortizations and aren't capable of meeting the new payment to pay down 25, 30 year on the, like, to get back to a 30-year amortization schedule, then more of those properties will hit the market.
I also think that, like, I speak to clients day in and day out who took a 1-year term, 3-year term during COVID that are coming up for renewal right now that have a 2.99 rate and that are going into a 5.5% rate, and the only option for them is to sell their property, right? But I think that's going to have an effect on supply as well, I'm sure.
Yeah, I mean, like, the cost of the carrying cost of homes, that interest cost, is going to continue to impact the marketplace. The thing we're like, have we passed the period where it was going to have its most pronounced impact? Probably not, right?
Right.
Probably not. So probably more supply hits the market.
Yeah, so tons of people are still in a 1.99 interest rate. Right. You know what I mean? They haven't felt the full impact of what we've done to the market.
Yeah. So that's another good point. The longer we ride this wave of high interest rates, the more borrowers will get kind of caught by it.
Exposed, yeah.
Right? So, like, every year that we have higher interest rates, every month, in fact, more and more mortgages come up for maturity that are subjected to the increased rate.
Absolutely.
Yeah.
And then I think Matt kind of asked it before, but you think housing is what other factors are there that are, like, driving inflation? Is it just housing?
Right now, the biggest impact on that last CPI reading is shelter costs. Yeah. Right. Is how much the cost of debt is increasing in the inflationary numbers, shelter costs.
Right.
Which is, caused by increasing rates.
Right. Which is everyone's biggest.
Listen, there's more variables that we can, like, look to for housing, like, immigration. Like, there are other demand side variables that we can plug in, but I don't think any of them, can meet the supply side if rates continue to drag higher for longer and more houses hit the market. That would be the fear. Right. Like, I'll tell you, when we're pricing deals for the MIC right now, we're not like, oh, we're totally out of the woods. a 15% drop in real estate prices is still possible.
Right.
Right. I wouldn't just,
You wouldn't count it out.
I wouldn't get the ticker tape parade ready yet for the comeback of the real estate market.
Right. Right.
Especially if we start getting more listen, the news was really bad over the last year for real estate pricing. Like, you couldn't read an article anywhere without
Yeah.
Thinking that real estate prices were just going to collapse.
Yeah.
But I just feel that, we've done such a good job of keeping the supply tight, and we had so much demand return into the marketplace that the natural result was going to be prices would run up.
Question. Do you think, so you talk a lot about how Fed speak influences interest rates and stuff like that.
Yeah.
Do you think that the media frenzy about housing prices had a lot to do with housing prices going down? Because it scared the shit out of a lot of people. You know what I mean?
Yeah. For sure.
Yeah. Right.
Yeah. I mean, it definitely made people think I don't want to act right now.
Now's not my time.
Yeah.
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 Marcus, so let me ask you, this idea that amortization is being stretched out. I mean, a lot of the culture in Ontario has been buy a starter home, a few years you refinance or you upgrade and you sell. But if people are stretching out their amortization, housing prices are lowered. Does that mean that trend is going to change over the next 10, 15 years, that people are going to be stuck in their homes longer instead of waiting for that equity, or they're waiting for that amortization to lower? That moves like that now seem like years, a decade away, right? Am I wrong?
I think the people that really got caught were the people that bought closest to that price peak, right? So for those people, for sure, it's going to change how they operate, right? They're going to be, and listen, if you bought at the peak in a variable rate, there's a good chance you're in a negative negative equity position. Never mind negative AM.
Mm-hmm.
So for people like that, for sure, you got to look at it, right? For sure, there are people that bought a house in Hamilton or Stony Creek or Peterborough, whatever, in the suburbs, further suburbs, the commuter kind of places, at the peak, at a variable rate, who have seen serious price declines and serious interest rate increases. And for those people, yeah, things have changed. I don't think it's changed for everybody. I think where stability in housing prices is kind of maintained, and where, even if the variable rate mortgage, though, it's going to hit them. It's going to be eroding equity. People are seeing equity erode. Does that maybe it extends those timelines a little bit, Matt? Yeah, maybe it extends them. But then again, once interest rates drop, if we see prices increase, do we not just go back to the same thing we were?
Yeah.
I will never be one of those people that just jumps on board and says, oh, that's the new normal. You know why?
Because the new normal is bullshit.
The new normal is bullshit.
We should get a shirt that says that. I hear more and more about pre-construction projects being delayed, likely due to the cost of materials, correct? Or is there other factors?
I think the pre-constructions are now coming back online, but I think the biggest reason they were delayed was because they couldn't sell the units.
Right. And this probably has something to do with supply as well, right? I can't remember the numbers, but there was tens of thousands of units coming onto the market, at any given time. And I feel like that's kind of tightened up a little bit.
So yeah, in the first half of this year, there are, I think 20,000 units that were sold coming online.
Right.
And the fear was a lot of those would get checked into assignments, or people would be forced to close that weren't really looking to close because they were hoping to have sold them before they closed. And as a result, appraisal values would be coming in significantly below purchase price, but they weren't.
Mm-hmm.
Right. We saw that kind of stick through, the market kind of made its way through on that so far. So the crisis that we were planning for didn't really happen.
Mm-hmm.
I think that a lot of the demand is returning to the market, and the pre-construction market has a pulse again.
Mm-hmm.
So I think a lot of those projects are now coming back online.
Mhm.
Like you can see it already, right? The pre-con market's back, which is a good thing, right? Again, we talk about it all the time. The pendulum swings one way and then it swings back the other way.
So, Marcus, about this pre-construction units, I recently heard that people that maybe bought in at the peak are now having their appraisals done as they try to close a year and a half later, and their appraisals are coming in much lower than their purchase price. Are you guys, Justin, are you seeing any of that happening in the market right now? Or like, Marcus, how do you think that that's going to affect, the market, like people trying to close or being forced to close?
Yeah, I mean, Marcus, you just mentioned that it's not really happening, and I don't really see it happening. But also, some of the units that were bought just before COVID that were like a 4-year build or a 5-year build that were bought for, like, I remember doing one in Yorkville that was like $1,800 a square foot. I mean, those haven't come online. Those haven't like gone to registration yet. But like when they do, I mean,
I don't think
it's a lot of money.
I think if you look at the per square foot price of a condo in Yorkville right now, I don't think it's that far below $1,800.
Right.
I don't know what it is.
Wild.
I don't know what it is. Matt could probably look it up right now.
Matt.
But if it's $1,600,
right, then yeah, in a year, I'm sure we'll be at 1,800. So no, I haven't seen that myself.
Yeah, I think we haven't. It has not been as bad as what we thought it was going to be.
Yeah, no, totally. And maybe we thought it was going to be as bad as we thought it was going to be because,
Fed speak. You're going to bring it back.
Yeah.
Honestly, I just think the media kind of
hyped it
took
up,
the story and ran with it, and everything was muted because the banks extended amortizations.
Right.
That's a way bigger story than what has been in the news so far.
Yeah.
Right. The bank's extending AMs. Like 1 in 5 borrowers has an extending AM, rolling AM. Like that's a big thing.
Right. Right. And then one more silly question. We might cut this because this might be a silly question, but I'm going to ask it anyways.
Right.
If Silicon Valley Bank were around today,
Silicon
Valley Bank were around today when the bond yields just went back up, would they still be okay?
No, it wouldn't be enough because they don't operate in Canada.
Right. Of course.
They did operate in Canada, but not. Listen, the 50 basis point increase in the bond yields
would
not have been enough, especially the fact that it happened in Canada.
Yeah.
Would not have been enough to save Silicon Valley Bank. And I'll tell you, like, this 50 basis point hike, you can see how dramatic it is.
Yeah.
Right. And that's not expecting 25 basis point hike. That is just the market absorbing that rates are going to be higher for longer. That's what that is.
Right.
And that's the thing that would worry me. The only good to come out of this is if you are traveling this summer, the Canadian dollar is likely to be stronger.
Right.
Right. If our domestic rates increase like that or our yields increase, so too does our dollar.
Time to go to Europe.
Yeah. Right now?
Yeah.
Okay, let's go.
Let's do it. I'm in. Well, I think that ends it. We spent a significant amount talking about space conspiracies, which we cut out of this, so you're welcome. And I look forward to sitting on these couches with you again soon.
Me too.
And I'm very confident that we're the only people in this infinite universe that are sitting on this couch right now. Just to plug into our conspiracy a little bit.
This one for sure.
Yeah. This specific one. Bye.